We have just received another tremendous warning from the legend himself, Michael Burry. In a recent tweet, he told all of his followers to sell right before the FOMC. Now, of course, we know what happened. The markets have remained resilient. It's remained strong. And he's deleted his tweet since and also gone as far to delete his Twitter profile. Now, I want to take a moment to walk you through some of the sentiment data that's been happening in markets so far. I've been running a couple YouTube community polls that I wish to share with you. Take a look at this question here. I asked my friends on YouTube, you guys, do you believe that we can reclaim all-time highs this year on the S&P? And almost 30% of the good folks here say that yes, it's possible. Let's take a look at the composition of the recent rebound that's been taking place this year. Pulling up the index on my War Charts dashboard is a lot of the big tech names from FANG plus Tesla, and pulling down the index on the S&P. These are some of the defensive names that worked really well last year and now it appears are being rotated out of and into the growth names. When I ask my friends, how is the local economy doing around you? A lot of people, up to a third, are saying the local economy is actually really strong. And only 18% say that their local economy is weak. And this explains my follow-up question where I say, what do you think is the probability of a soft landing? Where only 35% of people think that there's a 0 to 25% chance. A significant amount, 65% actually, believe that the probability is 25% or greater. Now guys, if you're new to my channel, my name is Larry, and I talk about US and China macro strategy on YouTube, off YouTube. I've got an email list. It's called Substack. I help a lot of people on it, and I hope to help you. Make sure to follow me on Substack, links down in the description below, and also follow my friends on Substack who we cross-recommend. Also follow me on Twitter for thought-provoking tweets. Links in the description below. Don't fall for impersonators. I want to walk you through some US macro data that will inform your understanding of why Michael Burry is so bearish on the market. Look here, the US credit card debt, it jumps 18.5% and hits a record 930.6 billion. Obviously for consumers, that's a very negative type of data point. Average balance now is $5,800. And what's the APR on a lot of these credit cards? We're talking about 20 to 25%. So not only are people having affordability issues because of inflation, now the credit that they're using, they're assessed higher interest rates. And if they miss payments, then their credit score goes down. So we're talking about a triple whammy. The economy on the surface, though, looks really strong. Look here, the payrolls, they increased by 517,000 jobs in January, crushing estimates. And unemployment is now at 3.4%, hitting a 53-year low. Now, if you haven't followed my channel or watched a lot of my videos, I want to take a moment and just explain how non-farm payrolls are created. So when one person, say, takes 3 jobs, that actually accounts for 3 jobs in this 517,000 figure from January. So let's say someone from Meta or Facebook or Google got laid off and now is working 3 restaurant jobs at 3 different restaurants to make up for those earnings. Well, that counts as 3 jobs in this index, something to pay attention to. Let's take a look at the National Financial Conditions Index. It indicates how loose or how tight Americans are feeling from a financial perspective. The more negative the curve, the looser the conditions, and the more positive the curve, the more tight the conditions. We can see here that since the fall of 2022, this curve has been trending downwards, indicating that conditions have gotten looser and looser against the Fed's strategy to tighten conditions. We can see this actually playing out in housing now. Let's take a look here. The housing market. We're seeing first-time home buyers now jumping back into the market because rates are dipping below 6%. I've got a chart to show you that illustrates how far interest rates can impact the stretching of your dollar when rates go down here. And we can see that when rates go below 6%, a lot of people can actually now qualify for homes that they couldn't qualify for when rates were at 7% just a couple months ago. Now, there are some other angles that I wish to show you to study inflation, because we know that if a lot of first-time home buyers jump back into the market for housing, that will blunt the deceleration in housing later in 2023 going into 2024, which will slow down the Fed's fight against inflation, which is what they don't want. I want to show you some other angles though, because the index has more than just housing. It has energy, it has commodities, it has services, shelter, transportation, healthcare. Look here, there's been a record-breaking fall in long-term rates for ocean freight rates as carriers brace for a recession in 2023. And I want to show you a chart from the Freightos Baltic Index. It shows you essentially the freight rates that are on the spot market today. These are the live rates that are happening in the market today. And you can see that since the fall of 2022, these rates have collapsed. But since the fall, the deceleration has greatly declined in terms of its pace. And that means that if the global demand for trade, thanks to China's reopening, starts to pick up again, we could have these rates pick up later this year into early 2024, and that could also slow down the decline in the transportation index in CPI. For that reason, when we combine housing, what I just showed you on declining mortgage rates, making people jump back into the market, and what I just showed you here on the freight rates falling, but now having its slope flattened out in terms of its decline, we could see the fight for CPI get a lot tougher in that 4 to 5% region. And for that reason, I think that investors may be a little bit too early if they think that inflation has been slayed. Let's talk about China next. I was hoping for the geopolitics between the US and China to warm even more since the beginning of the year, get even more constructive, because there was an upcoming meeting between Blinken and his counterpart, Foreign Minister Qin Gang, to talk about Russia's war on Ukraine. But that meeting has been canceled because of a Chinese balloon that was detected floating over the US. Now, I'm not going to get into the geopolitics over that, but essentially what I was hoping for was the market risk premium for the Chinese internet sector to continue to come down, which would be supportive for Alibaba and be supportive for the K-Web internet ETF. But this meeting has been postponed, so something that I'm watching out for. Now, in a note to my members on Substack and on Patreon, I have been warning for overbought levels on China, and I've been showing several technical perspectives such as RSIs, Bollinger Bands, to help members understand that near-term risk-reward just wasn't favorable. So we did have a lot of members take profits between 115 and 120 on Alibaba. I'm not saying that that level cannot be reclaimed in the future, but near-term, the easy money has been made. Long-term, I remain constructive on China. We have to understand the difference in time frames. If you've been following me for a while, there's a very big difference between a near-term opinion, an intermediate-term opinion, and a long-term opinion. Now let's talk about some geopolitics that are happening in the US. Here we have Biden, McCarthy talking about the debt ceiling to talk about preventing a default. Now, most people don't really understand the implications about the debt ceiling, but I want to help you understand this because this is an indirect tailwind to US markets in the very near term. We're talking several weeks to maybe a couple months. Look here, Treasury Department in January began so-called extraordinary accounting measures to avoid default, so the US can keep paying obligations to bondholders, Social Security recipients, and others until at least early June. What this means is that liquidity is actually entering the system, and that partially explains why markets have been supported despite things like poor earnings, despite things like tight job market. But liquidity doesn't last forever, and I'll be paying attention to this. This is something that I talked about inside my investment community to help my members understand the mechanics. We have the Treasury General Account. And the Treasury General Account is a liability on the Fed's balance sheet. And when the TGA goes down, reserves go up, and that's essentially an injection of liquidity in the system. And I linked reports to help my members understand the implications behind this. That explains a lot of the market's recent resilience. Next up, I want to talk about fundamentals. I want to talk about the earnings color from Apple, Amazon, so that you don't have to read their earnings transcript. I've done the work for you. Let's take a look here. From Apple, So Apple, from Tim Cook, he says they're no longer having supply issues. It's now a demand story, and demand has slowed down for some of their higher ticket items like the Mac. Now, when asked about China, especially the Lunar New Year, Chinese New Year, Tim Cook avoided talking about the January results from China, instead focused back on November and December. So those data points, they'll be released next quarter, but safe to say, I think that Apple is doing decent in China, but I think that any upbeat expectations in China have to be kept in check because their economy is still healing from zero COVID. Now, on macro, Apple is saying that they're seeing impact on Mac and in services, and it's felt the least in the iPhone, which is a necessary item. This conveys to me that when we think about consumer discretionary and consumer staples, Apple is a signal that discretionary items are under attack, and staples, those are still safe from the recessionary forces that we're feeling. I expect this trend to play out later this year. I know right now discretionary is outperforming staples, but later this year I do think that there will be a rotation from discretionary back into staples. We will see. I'll follow the story. Up next on Amazon. On macro, Amazon said that the backdrop is very challenging. They also said that on general spending, it's clearly coming down for the consumer. They see it in their numbers. Amazon is the largest e-com business in the US. And for them to say that, that's a signal that fundamentals are deteriorating. They're even saying that enterprises and their spending, they're more cautious than usual. So we're seeing B2C businesses, we're seeing B2B businesses, these categories slow down. Now that's not being reflected in the S&P 500 for now, but it could be reflected down the road. So what I'm asking my friends on YouTube to do is to practice patience and not engage in FOMO. I think that a disaster is waiting to happen for those who FOMO. Now on AWS, which is Amazon's crown jewel, they have talked about how forecasting is exceptionally difficult, talking about the uncertainty that's abound in 2023. And then finally on Google, I don't have a lot of commentary on Google because they're focusing on efficiency just like Meta is. My understanding of their report is that advertising is still challenged. Now let me walk you through some things that we've been doing inside our community, 4 action points, okay? Here's the first one. Action point number 1, several weeks ago, I talked about caution on Alibaba in the 115-120 region. Here I said, for those who care about Alibaba and how it looks next month, it's probably a time to scale out of positions now or close to 130. That's what I said a couple weeks ago. And action point number 2, I talked about Zim. This is a shipping company that reflects shipping rates. Just a couple days ago, I talked about Zim at 19 for a reinflation idea, now 23 or so. Here's the thing, Zim is a value name. Zim is not a growth name. So yes, Zim has rallied in conjunction with the market, but it rallied for a different reason. And because Zim rallied for a different reason, the quality of its rally adds to the fact that a portfolio can lower its variance and increase its Sharpe ratio because of names like this, because it's a value name and not necessarily a name like Shopify or Etsy. Now, please do not take my videos and just buy the company right after I talk about it on my channel, because prices change every moment. They are fluid. I give these ideas to my members first. By the time I talk about it on YouTube, the name's probably moved about 10-15%. So I don't think that people should chase at 23 or so. Action point number 3, I discussed caution on gold as overbought. And I now officially like gold long term. I don't have a position in gold yet, but I do think that near-term price action needs to be corrected first. And I talked about that when gold was at 1930. Now it's sub 1900. I like gold. I'll be talking about levels inside my community where I think accumulation is appropriate. But in the near term, gold is overbought. Action point number 4, I discussed that the dollar potentially as a rebound trade through ETFs that I talked about with my friends inside. It has the potential to lower portfolio variance and raise the Sharpe ratio. Now I know that these are some professional investor terms that I'm talking about, portfolio variance and Sharpe ratio. And the reason I talk about that is this. I don't want people to just think about maximizing returns as the ultimate goal. It's important to maximize your returns in the context of lowering the variance in order to get there. That way, you can achieve a similar outcome as the index while reducing risk. And when your Sharpe ratio is higher than the index, but your return is similar to the index, that means that you got similar returns without taking as much risk. And that's something that I would urge everybody to do. That's one of the core principles from the CFA Institute. I want to share a note here. Do not buy or sell stocks that I'm talking about on the channel. They've moved up by the time I publish this video. Prices are fluid. They move as long as markets are open. Ideas are shared with members ahead of time. So if you're interested in intermediate term investing, make sure to join my public list down below or join as a member. Now, if we take a look at a longer term outlook on the S&P 500, here are my thoughts. I think that the window for a soft landing has somewhat been extended. This is a note that I sent to my members, meaning that near-term momentum is higher. However, I don't think the long-term risk reward is favorable here, and I think that a disaster is waiting to happen for people who chase too late. So for those of you guys who are looking to navigate this bear market as safely as possible, there are even financial advisors and investment professionals inside my community. And believe it or not, I don't charge separate rates for financial advisors or investment professionals. I know I should, but I don't. And these folks, these very good folks, they're leveraging my research for their clients, adding value to the people that they serve. And I'm happy to help them, and I hope to help you as well. So I would encourage you to take advantage of what I have to offer to navigate this bear market. Make sure to follow me on Twitter. Don't fall for impersonators. And in regards to what I think, my final conclusion from Michael Burry's warning on selling everything, I think that eventually he will be right. It's just about the timing, but eventually a big sell is coming, and I want you to be ready. I'll see you guys in my next video.